show you this, but I couldn't get it to come up. So when we talk about covered members, right, a covered member is any individual on the audit engagement, right? So if you're on the audit engagement, you cannot have a financial interest in the client, right? Obviously, right? So, so any individual in a position to influence that engagement. So usually if you are a staff person, right, you might not have the ability to influence it because you don't sign off on the audit report, and you have all these different levels that you know, that will look over your work or review your work. So you really don't have that much. So you could be a staff person in that audit firm, but you wouldn't be considered somebody who could influence an engagement. Right? But if you are a staff person on the engagement, you have to be independent. So an individual in a position to influence the engagement would be somebody like a partner in that firm. Even though the partner is not on the audit engagement, that partner in the firm, in that office, might be able to influence the engagement. So they can have a financial interest in the client, even though it's not their audit client. Or even sometimes a manager, right? So I just want to make a point too about most firms, and I would suggest that all the firms have their own, in addition to the minimum requirements of Rule 101, audit firms will have their own requirements for independence that their employees have to adhere to. So these are what I'm talking about, the minimum standards under Rule 101, and audit firms will have standards on top of that or requirements on top of that, which may be more restrictive. So a partner or manager who provides non-attest services, right, so non-audit services to the client, beginning once he or she provides 10 hours and so forth and so on. So basically, if you're providing some other service to that client, then again, even though it's not an audit engagement, the fact that you're providing other services to that client, and you're a partner or manager, you can have a financial investment in the firm, in your client. Again, a partner in the office, any partner in the office, the firm, including the firm's employees and an employee benefit plan, and then any, you know, if you have, if there's a financial accounting policies that are controlled by any individuals or entities, then they're also prohibited, right? So, but basically, the three that I want you to key in on are the fact that, one, any member of the audit team, that's an obvious one. Any member in the audit firm that has the ability to influence that, and that's usually considered partner, the managing partner, so any partner in the firm, some cases a manager. If you're providing non-audit services to an audit client, and we'll talk about the fact that there's some prohibited services that firms can't even provide to their audit clients, okay? And so family members. So if I am, again, if my spouse is in a financial reporting role at an audit client, then I am not independent, so I should not be assigned to that audit. Okay? It's only, so now if my spouse was in a non-financial, so let's say my spouse was in charge of research and development, was a vice president of research and development, that person has no, a person in charge of research and development has no involvement with the financial statements or control over financial reporting. So my spouse would not be considered a covered member. Now, that being said, you know, a firm might say otherwise. But for the minimum requirements of the standard Rule 101, my spouse would not be considered a covered